Welcome to the Strothman and Company Strategic Advisory Services webinar. This webinar is going to be on quality of earnings. And I want to thank everybody who's come to participate with us and watch the seminar. This is a series that we do here at Strothman to continue to educate our clients and to bring you the information that really makes a difference to you in the world and can help impact you with your business. Today, we're going to have a round table panel discussion. We have brought in some very qualified and interesting people to discuss quality of earnings. And for those of you that are not completely aware, quality of earnings is a audit that is performed by Strothman and Company and other accounting firms to help buyers, private equity companies, sellers, and other interested parties, including banks, in the transaction to verify the quality of the earnings on a forward-looking basis versus a backwards-looking basis. And it's becoming more and more important in today's environment, with COVID being as relevant as it is in terms of businesses being able to manage their forward-looking pro formas and to understand where their business is going. This tool is critical in terms of determining valuation for companies that are looking to sell, valuations and issues for companies looking to buy, to identify what they're buying, and for banks in general when they are providing capital to the buyers and financing these deals to understand exactly the risk that they're taking on. They are something that has been around for a long time. They've been used very extensively with larger deals, but as we go forward, we are seeing more and more activity coming down market. And as you know, Strothman and Company focuses in the Louisville market and regionally on the lower middle market companies that are out there. And that is our specialty. Today, we are very fortunate to be joined by a number of individuals on the panel. And I'll let each of them introduce themselves and give you a brief description of their background. But we have in Nashville, we have Tatjana Paterno. We have Steele, Windle from 5 Points Capital. We have Bill Meyer joining us, who's the managing partner of Strothman and Company. And we have Mick joining us from Regions Bank. So Tatjana, I'm going to allow you to lead off and give us a little bit about your background and where you specialize, and let everybody know who you are.
Thank you, Matt, so much. Can you guys hear me okay?
Yes.
Okay, great. Well, it's great to be here. I'm Tatjana Paterno. I'm a partner with Basberry and Sims in Nashville. We are a full service law firm and have offices in DC, Nashville, Memphis, and Knoxville. My practice is primarily focused on M&A, lower middle market M&A in healthcare, manufacturing, retail, those sectors. Thanks for having me here.
Great. Steele?
Hey, everybody. Good morning. Hope you can hear me okay. I'm Steele Windle. I'm with 5 Points Capital. We are based out of Winston-Salem, North Carolina. 5 Points is a private equity firm. We've got about 30 people on our team, and we manage a little over $1.5 billion of capital across 3 separate fund strategies. I am intimately involved in our private equity fund. We're investing out of our 4th equity fund. It's a $230 million vehicle. And we also have a credit fund. It's a $265 million fund. We're investing out of our 3rd fund on the credit side. And so we're very actively involved in the lower middle market. And I think, have decent perspective in terms of a lot of different company types and the importance of quality of earnings and what that means for us as investors.
Okay, thank you. Mark?
Hello, everyone. Thanks for having me today. I'm Mick. I am the Kentucky market executive for Regions Bank. And Regions is a $130 billion asset bank. We have a 14-state footprint that covers the Southeast, and Texas, and I have responsibility for the Kentucky market. So it's a pleasure to be here. I work with companies that are range in size from 10 million in sales to a $500 million in sales.
Perfect for the market. Okay. And Bill Meyer, we'll let you go next.
Save the best for last, right? Well, good morning, everyone. I'm Bill Meyer, managing partner of Strothman and Company. We're glad you're with us today. Before Strothman and Company, I was with a small firm by the name of PricewaterhouseCoopers for a number of years. Over the years, I've been both at Strothman and Company and PwC, been involved in a lot of deals, both on the buy side and the sell side. I've got my business valuation credentials, not so much to do valuation reports, but to be able to advise clients on the proper prices and values to be able to buy and sell their business. So I'm glad to be with Matt today. Matt's been a great asset to our firm since he joined us a few years ago. Matter of fact, one of the first projects that Matt did was I had a client who got an unsolicited offer from a potential buyer, and they were interested, and he didn't quite double the price, but he almost did. So we were glad to have Matt on board to help with that. But
All right. Well, thanks for that, Bill. And I'm Matt Saltzman, and I will be moderating and participating in the webinar today. I am the Director of Strategic Advisory Services for Strothman and Company. My background is a Wall Street background, and we specialize at the Strategic Advisory Services level in 3 specific areas. We do workouts, turnarounds, strategic advisory for clients, for their companies, to help them get ready for sale if that's what they want, or to help them be prepared to grow and acquire if that's what they want to do. We also specialize in transactional advisory, where we focus on buy side, sell side, and facilitated transactions where both parties know each other. So we work very much with companies in those areas to help them get ready, and the quality of earnings is clearly a critical piece of that as we go forward into the new age of post-COVID and the end of COVID. And then finally, we focus on capital structuring and sourcing in order to help create the proper financial levels and capital stack so that companies can actually complete the transactions that they engage in. I am very grateful to all of my panelists for joining me. As you can see, Strothman and Company, we have relationships that range far out of market, and we are fortunate to have these relationships and to be able to bring the kind of expertise to you today that has agreed to participate with us on the panel. So with that, we're going to get started. And the first topic for the day is quality of earnings. And essentially, for those of you that are not totally aware of a quality of earnings report, it is a report, as I said, that's forward-looking and essentially allows a very deep insight into the things that a company has to face when looking at the future. So, for example, in today's world, we may be looking closer at real estate leases and the impact of that as we move more into a virtual world. We may be looking at how your supply chain is working and whether or not you can get consistent supply, whether or not your customers have the ability to pay. So it's a very, very deep dive. And the first question that I'm going to ask the panelists is are the earnings from history reflective of tomorrow? And this is going to be an open conversation. As the viewers can text in their questions, we'll have some time at the end for questions and answers. But the first question I'm going to ask, and I'm going to send that to Tatjana as the first one, is when you look at earnings from history, when you look at that for your clients and they're getting ready to sell and represent things to buyers from a representative point of view, they have to be very careful about the representations that they make. What are you hearing from your clients, or what are you advising them as it relates to this aspect of it?
Yeah, I mean, I think just because of the environment that we're in, we're seeing more and more clients on the sell side to kind of have a quality of earnings analysis done in advance of the transaction. And this is because exactly so they can identify issues forward looking. Maybe they're not thinking about them, but they can prepare for kind of what's coming and the questions that they're going to get from the buyer. So that's really important. And I think it can also, once you understand what future looks like, what are the issues, you can try to address them. You can be prepared to respond to questions. So that's what we're seeing from our clients on the sell side.
Okay, so Steele, as someone who's predominantly on the buy side, do you find that sellers that are prepared with the quality of earnings make for better candidates in some cases, or just more difficult candidates because they're going to have competing numbers with you?
Yeah, it's a good question. I think that sellers that come to the market with a sell side QV prepared they are preparing themselves for a much more successful sale process because the numbers have been thoroughly vetted and you're presenting financials that are representative of what normalized earnings should look like going forward, and it gives you a head start as you present your company to the market. A more vetted and thoughtful preparation of the financials certainly prepares you better to have a successful sale process rather than not going through that exercise in advance. We certainly will do our own diligence on the buy side as an investor to, poke and prod and really assess what our view of normalized earnings might be, which is the ultimate purpose of the quality of earnings analysis. But the companies that go through that exercise first on the sell side are typically prepare themselves for a more successful sale process in our perspective.
And is that because they predominantly have a better understanding of their business and can explain things to you more clearly? Or is it also because the work for you is a little bit easier at that point and you can get to the more substantive questions more quickly in the process?
I think it's both. I think that it's the thought that goes into preparing that analysis shows that the seller has gone through the exercise of presenting a fair assessment of what the historical and future earnings of their business really is, which really helps the buyer come up the curve more quickly in formulating their own assessment of what earnings stream they are considering acquiring. And it just shows that you've gone through the exercise of thinking through all the considerations that need to be made in terms of what those normalized earnings really are, particularly in this environment where a lot of companies have seen some impact, either positive or negative, as a result of the current circumstances we're going through together.
Right. So they're probably in a better position, to Tatjana's point, they're probably in a better position to negotiate with you, having done that work, and they're a more serious seller, in your opinion, is what you're saying.
We would agree. Absolutely.
Okay. And Bill, when you work with companies in helping them prepare for something like this, like an event, like the one that we talked about, do you find that what has gone on before in the normal audit and tax situation is not sufficient for a transaction environment, that the work has to be done is a little bit more analytical, a little bit more thoughtful? Speak to that a little bit in terms of some of the things that you help clients look at and where they should be looking beyond just a simple submission of tax returns and naming a price. Bill?
Yeah, I had to unmute myself, forgot about it. So yeah, any acquirer would want, 3 to 5 years of tax returns, 3 to 5 years of annual financial statements, preferably audited. And that gives you a lot of information, but that doesn't tell the whole story. Forget COVID right now. Many companies have ebbs and flows in their business, and it's very hard to tell from history how those 3 to 5 years of track records are going to project into the future. So it takes a lot of analysis to see, how is that really going to affect the business going forward? Were there, what are their excess officer salaries, especially a lot of closely held companies, they they take out a lot of money, not only in compensation, but in perks and things like that. Now with COVID, I was been working with a company today. Actually, they're not going to sell themselves, but their earnings have been very steady, very flat. COVID did not affect them one bit. But I've been working with another company that took a pretty big dip. They were having a great run. They took a heck of a dip in 2020, but because they are tied in with a lot of government contracts and so forth, they really see themselves coming out of it pretty quickly. But they're trying to do a deal with a strategic buyer, and they're trying to show, and I'm working with them trying to show the how those earnings and revenues are going to come back in relatively short order. But it's challenging to just try and pick something up from tax returns and financial statements.
Right. So in that particular case, a quality of earnings report might dig into the change in the election potentially, or how the election will impact that, because government contracts will be directly tied to initiatives and electoral vote direction and funding, obviously. So
Sure.
if we had a Q of E, that would kind of work into those factors and be very instructive for a seller who's looking at a strategic buyer to try and maximize the earnings. Is that some of the work that you see going on in that area, that type of thing, where you have to dig behind the numbers and ask second and third level questions that are more strategic and less on the surface of just submitting a bunch of tax returns and financial reports?
No, absolutely. Absolutely.
All right. And Mark, as a bank who's ultimately going to be responsible for providing the money to make these deals work, writing the check at the end of the day, what is it that you're seeing out there, and how do you evaluate the companies, both from buys and sells and during the transactions? And then I'm going to have a follow-up question for you that goes beyond just in a transaction state. How do you look at the whole quality of earnings question, especially with what's going on now?
Well, typically when we're working with a quality of earnings report, it's in the context of a financing a purchase transaction for our client who's the buyer. So we really love to have those reports. They definitely help us understand the soundness of the revenues and the earnings. And so we're particularly focused on the EBITDA adjustments. So when we're looking at pro forma financial statements or projections for our client who's the buyer, we really want to have a good understanding of those EBITDA adjustments, if they're sound or not. Building that EBITDA bridge, as we call it, within the transaction, that bridge leading to the number in the pro forma financial statements.
So do you tend as a bank to go in and actually normalize earnings so that when you have things such as what Bill was talking about with the government contracts, or you have a disruption from something like the COVID, that you have to go back and understand not only what would be normal, but what's going to be normal given any kind of destruction that's come into play?
Yeah, absolutely. We're hyper focused on the impact of COVID on businesses. And so we really want to have a good understanding of the impact on their business going forward, and how that may play out in the pro forma financial statements.
And so in your opinion, then it's extremely important when your underwriters get the files and you have to go make the explanations to the underwriters, that you have an understanding of what that is.
Absolutely.
Yeah, because in the end of the day, it's really the underwriters that are making these decisions, right?
True, but they're our partners, our credit partners, and we want to be very transparent with that data, have a good understanding ourselves, and come to an agreement about how sound these earnings are as reported.
Right. 'Cause I think it's important for the audience to understand that although they love their bankers, you guys really aren't the ones that make the ultimate decision.
We have a for sure.
You have influence, but the final pen. Do you find that quality of earnings is starting at all to be discussed or transfer over into non-transactional loans? So it may just be a loan for a company that is coming in looking for a larger credit facility. And is there any conversation or discussion about actually reaching into the quality of earnings now because of these questions that go beyond just a straight transaction phase where they were predominantly used before?
I don't know that we're necessarily requiring QOB reports from an independent firm like Strothman, for example. We're more focused on going forward, the impact of COVID on the business, a little bit less focused on the historical statements, and heavier reliance on the most recent quarters. And really building our picture or our outlook from there.
Okay, so looking more forward at this point, and haven't gotten quite to the QOE yet, but at some point, depending on how dicey it gets, it could be a good tool to have for somebody who wants a loan. For somebody who's looking for a loan, they may want to invest in that and have it for themselves, just to have it for a bank, especially if there's some hiccups in the back.
Yeah, absolutely. It's definitely an asset for us to have in getting full understanding of the transaction, for sure.
Okay. All right, good. And Tatjana, in your practice now, as you look forward, are you seeing more conversation around earnings being the driving factor in that representation? And secondly, how are your clients working with the issues around staffing and real estate and new product development and things that they're doing as they get into these transactions? How are you counseling them to handle some of those questions and to understand when they come to you to be prepared for sale, some of the things you're counseling them on in that vein as well?
Yeah. So in terms of earnings being a factor, I mean, that's a kind of back to the point that Mark made a couple of minutes ago, is that we really need to understand EBITDA adjustments. And we ought to remember that, and Steele can speak to this, I'm sure. But in a lot of times, the purchase price in the transaction is based on an EBITDA multiple. And depending on what adjustments you put in there, you can get a very different purchase price, right? So from that perspective, it's so important to have a good understanding of what those adjustments might be on the going forward basis, what's normalized looks like. In terms of kind of digging into diligence, yeah, it's so important. I mean, you can look at real estate leases, but if you don't ask the questions, okay, so what have you deferred paying any rent? How is that playing out? Have you reduced salaries, and how are those? How is that going to look like? When are those reductions going to fall away? So all of that kind of affects your understanding of the business, and where our clients are. I mean, on the buy side, they're very thorough, but again, just reminding about kind of high risk areas and things like PPP loans and how you're dealing with those. And so there's a number of things to talk about with our clients now.
Right. That was actually something I was going to touch on with the PPP and nobody understanding whether they're forgiven, forgotten, or going to be a problem. And the transactions coming up, I imagine that you're getting a lot of questions around that as you go forward.
Yeah, a lot of questions and a lot of structuring issues, right? It's not just, you don't get to just focus on the monetary aspect, right? If it's forgiven or not forgiven, and kind of perhaps putting that money in the escrow, you also have the issue of certifications that were made in connection with the application for those loans. And what if there is an issue from that perspective? How do you address that? So there's a lot of conversations going on like that.
Right. And I imagine that as you get into the reps and warranties, that is a feeding fest for you guys. That now, do you find a lot more time being paid being done in the reps and warranties section versus?
Yeah, absolutely. There's a lot of time that we spend in that section of the agreement, which is basically, it serves multiple functions. Part of one function that it serves is due diligence. And I personally like, even though, sellers make representation to kind of talk about in due diligence calls and what has been happening in terms of how they have been affected and their supply chain has been affected by COVID. We also like to get that in writing in the agreement so we can have, and that kind of creates an additional incentive for the seller to be thoughtful. What can I really represent in writing? I think it's just kind of creates a little bit more discipline. But then again, if you have a transaction that's kind of 25 million or more purchase price, then you can get representations and warranties insurance. And then the whole conversation changes a little bit because all of a sudden you have the rep and warranty insurer who stands behind those reps and warranties instead of the seller. So there's a little bit of kind of pull back and forth on that. And so that's it's another interesting area that's going on now.
Right. I would imagine that in the reps and warranties, it takes a little bit of coaxing with the sellers because they have to understand that the more transparent they are, the more protected they are, and the better the deal is going to go. And if they don't admit everything or put it out on the table, it's a short-term walk to a long-term problem potentially.
Yes, that's exactly right, Matt. Yeah, you have to be thinking about the big F word, which is fraud. Yeah, exactly.
Right. So that's there. And Steele, as somebody who works on the other side of the reps and warranties, I imagine this is an area that you are paying particularly more attention to as well. And just for the audience, before I go to Steele, the rep and warranty area is part of every transaction that essentially says, here are all my warts, here are all my potential problems, here are all the things that could go wrong. And when everybody signs off on it, everybody acknowledges that they understood this ahead of time. So when a wheel falls off down the road, everybody knows there were no lug nuts in the wheel. It's okay, at least to the best of their ability. It gives them something to stand on as a seller. So that's an area not to be ignored lightly. With that, Steele, from the buy side of that, when you see a rep and warranty area, if it's too short, is that a warning sign for you? If it's and something that you worry about versus one that's 17 pages long, and then you really begin to wonder whether this is a transaction you'd actually like to do?
Yeah, it's a good question. I think we like to ensure that the reps and warranties that we as an investor are signing up to are sufficiently comprehensive and capture all of the components of diligence that we would have uncovered through our due diligence period leading up to closing. And if there's a lot of legal issues or reps and warranties that could potentially become problematic as we discuss the specifics of those, it can certainly become require conversations between buyer and seller to specifically define and understand who's on the hook for what. And in those situations, it can become a lengthy document, as Tatjana, I'm sure, is well aware. As you noted, Matt, the very interesting thing about rep and warranty policies is that it really places a lot of the burden. It takes the burden away from both the buyer and the seller in many ways. The more forthcoming that you can be, and the more things that can be covered under that policy. It negates the need to have, escrows in place at closing so that more proceeds can go to the seller. And it's a nice feature and a nice, item that has really surfaced in the market over the past 10 or so years. And then the important thing about rep and warranty insurance policies is that in most every case, they will require a quality of earnings report to be completed in order for that policy to be underwritten. So, they kind of go hand in hand in that regard. But yeah, hopefully that helps provide some perspective there.
No, that's perfect. That's exactly where I was trying to hope that you were going to go, which is, to get the insurance, you have to prove the case. And these reps and warranties are not just, I have machines that haven't been PM'd in 10 years. It's all the financial implications. It's everything that goes back to quality of earnings and where the risk is. And in order to get that coverage of the insurance, they're going to require a very detailed analysis. And Mark, as a bank underwriting it, that rep and warranty section for you has to be fairly powerful as well.
Yeah, absolutely. We want to make sure that those are sound reps and warranties. Absolutely, it's a great thing to have in our quiver.
Right, because when you look at those, if they're not repped or warranted right, it's an emerging liability that hasn't emerged yet. It's a hidden liability for the future because if it goes wrong, it's not going to be good. Would you agree?
Absolutely, totally agree.
Okay, and Bill, let me ask you, as someone who works with the clients and their financials and digging this out, do you find sometimes that it takes a little bit of effort to get the clients to truly disclose things, such as where the add backs truly are? In these closely held companies, many times there are a lot of personal expenses that get commingled with corporate expenses, and untangling that spaghetti can be a little tricky. How do you find that when you're working with the clients, Bill?
Well, of course, a lot of those personal expenses that you're pulling out work in the favor of the seller because, the seller is basically saying, I've been taking all this money out, but, you as a buyer won't be doing that. And so they're add backs in the favor of the seller. They're, I think it's important, obviously, to take reductions the other way if there are unusual normalization type adjustments that need to be disclosed, because if you don't tell the seller up front, if it's a big enough deal, they're going to do due diligence and find it anyway, and that hurts your credibility. So I think it's important to have a good, honest relationship with a potential buyer to avoid problems with credibility and then problems with the deal down the road. You guys on the panel have probably seen a lot more deals go south than I have, but fortunately over my career, I have not seen that many deals, blow up because of problems in this area.
Okay, and I have a question for you. As a provider of the QOV, does it make a difference if it's provided by your current audit firm, or should it come from a third party that's independent of the audit firm? Or what do you think?
Are you asking me?
I'm asking you, Bill.
Yeah. So, those questions come up a lot of times in conjunction with like business valuations. Can you do a business valuation on a client? I believe you can, because a CPA is held to a certain standard of objectivity, and that's violated if you advocate in favor of your client when you say you're not. So I think a credible CPA ought to be able to do that. But I'd be interested to hear what Steele and Tatjana say about that. Do you think a report coming from the company's CPA is less credible than one from an external unrelated CPA?
Steele, I'll let you take that one.
Yeah, it's a good question. I think not necessarily. I think if the CPA has been involved with the business for many, many years, and they put forth a fair assessment of the historical earnings profile of the business and what the as Mark has pointed out too, what the adjustments look like, and that those can be substantiated as legitimate, one-time non-recurring expenses, then I think we certainly would underwrite or consider underwriting to the EBITDA that CPA firm had prepared. I think as an investor, we always come in behind and typically do our own buy-side quality of earnings review as well, to ensure that there's, some legitimacy to what's being put forth by, the sell side QV report, whether or not it's coming from, a CPA that company has used for years or an independent third party. I think we'll certainly consider both.
And Tatjana, there's really no legal reason that it can't come from the same source, correct?
That's right. More often than not, though, I see it done by an independent, by a third party in the sell side. On the sell side, that's usually what happens.
Right, and I think a lot of that is more style over substance, where they'd like to present that it's truly an independent arm's length, not transaction, but report, and so it's more stylistic to do it that way. And actually, for a seller, what I found on my sell side representations is I'd rather have a fresh set of eyes looking at things than someone who has been ingrained in the nuances of the corporation for years and may actually step over some things because they feel it's normal and they're not looking at it from a fresh perspective. So I think it's a great opportunity for sellers to be able to actually get an independent look and perspective while they're paying for this thing, and utilize that to their advantage and get the best of both worlds. Why not extend your expert advisor universe in an exercise that doesn't disrupt a pre-existing relationship?
Yeah, that's a very good point. Very good point, Matt.
Yeah. So
Matt, could I ask a question of Steele? You said you come in behind and do your own. Have you run into cases in the past where you've found a quality of earnings report overly rosy and not credible, or do you generally come to a similar conclusion when you look at it on the back end?
I'd say more often than not, we generally reach the same conclusion as the sell side QV report. But there are certainly times where there's a report put forth that's more rosy than we may see it. There may be certain adjustments that are being included and that are, you could debate whether or not those are legitimately non-recurring expenses, and the magnitude of what adjustment size is appropriate for that given topic. And that's really where we focus our efforts in trying to assess, what the appropriate adjusted EBITDA really is, because as Mark and Tatjana have pointed out, that's the big driver of purchase price for a lot of these deals. So it's a sensitive topic for sure.
Sure. I mean, we've had it where, you have to think about it. Every dollar you can drop into an ad back is somewhere between $5 and $7, $8 in purchase price in a normal world. And in today's world, depending on the type of company, it could be $10 or $11 that drops back to the bottom line. And that's a big part of what we get involved in too, is trying to make sure they're realistic in terms of the ad backs. There are reaches there where it goes right to the real estate leases. It goes to family members who work in the place and whether or not they perform. Suddenly they become non-essential, just no-show jobs, but you realize that they're actually doing real work and have to be replaced by somebody. So you can't just carve all that back. All the little things, the country clubs, things like that, they all go in there and they drop down. So the QOE, somebody asked a question and said, is it really a big deal? And the answer is yes, it is, especially for a seller, because a seller is going to have to negotiate with you on every one of these points. And my position is, if they don't have their own ammunition, they're basically working off of your list. And that's probably not the best place to start negotiating from.
Yeah, I would just comment that, in this environment, quality of earnings reports are immensely important. And I'd go as far to say that, almost 100% of M&A transactions in this environment effectively require a quality of earnings report to get completed and, across the finish line and get financing and all the appropriate insurance in place. It's a pretty critical component to the deal structure these days.
I would tend to agree. Even on a 10, 7, 8, 9, 10, $12 million transaction that does not get the insurance, that quality of earnings is going to go directly to the reps and warranties. And for Mark, when you look at these things, the add backs and everything else are critical for you when you're financing this. How important is it for you to understand with the person who's buying it and financing it, what the future looks like in terms of potential risk events?
Oh, that's paramount. I just keep going back to understanding that COVID impact and what it'll do to the future of the company, to its revenues and its customers. What's the pipeline look like? Absolutely, we're very focused when we're doing transactions today on understanding COVID's impact and what the possibilities are for the business in the future.
So when you look as a bank at the COVID impact, what are the top 2 or 3 items that now surface to the top that were not really there before the COVID? I mean, what things are you looking at? Leases? What kinds of external things that are not necessarily core operating items, but maybe some new flavors of risk that weren't there before?
Maybe inventory. It seems to be a pretty common theme lately. Talking to businesses that may have some obsolescence in their inventory. Inventory heavy. So I've been seeing that out in the marketplace a little bit.
Yeah, we've noticed that as well in certain cases. But all right, that's good. Thank you. So let's take a look at the QOE itself, the cost of it versus the benefits. We've talked all about the benefits. Just going around, Steele, what are you seeing as an average cost when you go to engage for QOE? What kind of price ranges are you looking at so that the audience can understand what this really entails?
Yeah, it's a good question, and I think the answer it varies based on the size of the business that is contemplating engaging a firm, and it varies based on the types of accounting firms out there that you might want to engage to help procure the quality of earnings report. Generally speaking, I think you could assume that the range could be anywhere from a $50,000 report and it up to meaningfully north of that. It could be as in some of the larger transactions with certain accounting firms, it could be $250,000, $250,000. But that's probably less typical, but that's kind of the size range that we generally see.
Right. So in the lower middle markets, you would see more to the lower end, 50, 60, 70. And in the higher multi-division, multinational, large 9-figure transactions, you'd run more towards the 250 range in that area.
That's probably about right. Yep, we would agree.
And Tatjana, are you seeing that as well on your end? And are the clients understanding the value that this brings for the investment?
Yeah, I think the clients really understand the value. I don't always get to see the numbers that the clients pay, but that sounds like the right range.
Right, and as the attorney on the deal, it sounds like you find the QOE has tremendous benefits for you as well, not only in terms of time savings of having to redraft and do things, and which you're very fairly priced, but I'm sure that there are attorneys out there that can rack up a meter fairly quickly. So it can save the client lots of money on the legal bills by having better information on the front side. Would that be fair?
Oh, absolutely. And another thing that we have not mentioned in terms of how QOV kind of might impact the dollars that will go to the seller at the end of the day. Another thing that where that comes into play in my experience is when you're calculating the working capital. Steele, you're familiar with that. But basically, typically there's a working capital adjustment. Usually deals are structured so that the business is supposed to be delivered with a normalized level of working capital. And the normalized level is whatever the parties agree to, but sometimes it's based on kind of a trailing 12 months average. Sometimes it's based on 3 months average. If there's seasonality of the business, it depends. But how that target number is calculated, a lot of times we'll take into account some QOB adjustments. And then how the final is calculated will also take that into account, which means that, you can, depending on what you take into account, you will get less money or more money. And if you have kind of an independent third-party report that you can look to, then there's a lot less argument about what goes into the target number. And to Matt's point, things just the negotiations go much smoother, and it's just easier. And from that perspective, I think it's easier for the parties, and it sort of pays for itself.
Yeah, I think that's a great point. One of the trickiest places that we always run up against the wall with everybody is on the working capital adjustment, because that's the place where there's actually real money coming back from the seller into the business, and they don't want to give up that money. And it ties directly into the AR adjustments. It ties directly into the clawbacks, the hold period, and it ties into the liabilities on the balance sheet that have to go. And then ultimately, it relates into seller financing, which in today's environment, it's a different topic than today altogether. But in today's environment, the saying is, seller financing is the new mezz. And it's what's there. So the seller financing is a big piece of this, and it has to be there, and that will tie into the capital adjustment and ultimately the flow throughs on the other side. Have you seen a lot of that?
Yes, absolutely. Seller financing is a big piece. I mean, we're working on a transaction where one of the on the sell side, where one of the offers we got included a significant seller financing component. Luckily, we had some others who had who were able to find their own financing and offer all cash. But yeah, if we didn't have this other bidder, we would have had to do seller financing.
Right, and cash deals generally are not as lucrative as seller finance deals.
Yeah.
There's a discount for cash.
Yep, that's right.
Steele, do you get involved with seller financing in many of your transactions?
We can. It happens every so often. I'd say almost all of our transactions do include some component of rollover equity from the selling party. And whether that comes in the form of equity or a seller note, as you know, it varies by deal. But rollover equity is very, especially in this environment where it just signals an increased level of confidence in the business that's being sold, and what we often refer to as the ongoing partnership that we want to exist between seller and buyer. It's a pretty critical component to most transactions that we look at.
Right, and then that allows you to maintain management teams, because not every company that you buy, you have bodies to slot in there for the management team. So it helps you retain management, I imagine, and also if the QOEs are right and everything else is right, then the rest of it falls into place where that management team can come along. And when the second liquidation event occurs, I've seen many times where the second liquidity event is actually larger than the first, even though they're selling a smaller percentage of the company the second time. Have you seen that?
We absolutely have. We often refer to that as the second bite of the apple. It's very often that we can partner with a selling founder of a business and acquire the company from him or her, and they roll over into the transaction, and the proceeds that they make on the subsequent transaction after our 5 or so year partnership together can actually be larger than the proceeds they received at the original deal. And so that's a function of the level of rollover equity that they put into the transaction alongside us and the value that we were able to create together.
That's good. That's good. And Bill, just going back to working capital adjustments, when you work with the clients and you get to the working capital adjustments on these transactions, I imagine there's a lot of negotiating and back and forth that you go through when you're looking at their books and figuring out what normalization is. Can you explain a little bit about it or talk to that just for a second?
Yeah. So, when you sell an operating business, you sell a normal or reasonable level of working capital along with that. In other words, sometimes a buyer might just want to buy assets and start from scratch, but most of the time it's an ongoing business and it has bills to be paid and people to be paid. So there's got to be an ongoing flow of working capital. The better that's spelled out in the documents, the better it goes. I won't name names, but I remember an epic situation with a local company here in town, and it was a huge battle for months over the working capital adjustment after the closing. So the reason that occurred is it was not clear in the documents, or it was subject to interpretation. So there was just a lot of back and forth and fighting over that issue. So if it can be spelled out in the documents with even some, examples, I'm not sure, Tatjana, if you do that much with agreements, is put, theoretical kind of schedules of how it will work as an example. But yeah, it can, if it's not spelled out, it can be a problem.
Yeah, that's a must in our agreements. We usually have here's a sample calculation of what the working capital would look like if we calculated it based on the balance sheet as of whatever pre-signing of the transaction, so that everybody can see kind of these are the line items that we are considering to be current assets. These are the things that we're going to back out. And so that everybody's aligned on how those numbers are going to be calculated. And then another piece to it is also making it clear that the balance sheet will be prepared in accordance with the principles, the same principles that the seller was preparing, right? Because we all know that GAAP is there could be two different answers and they're both correct, right? For the same issue. So Bill, to your point, you have to be clear, or you're going to have a dispute on your hands, which nobody wants to have.
I want to just say thank you very much to Steele and Mark and Tatjana and Bill for joining us on this. I think it was a nice discussion, very thorough, a lot of information out there.
Well, I second your thoughts, Matt. I thought it was a great discussion. And if anybody has any follow-up questions, please feel free to reach out. Great to see you all.
It was a great discussion, and in some ways, going back to the question of whether to get an independent report or get it from your CPA firm, I think your CPA firm knows your business so well. There's advantages there to go into the firm. So anyway, thank you, everyone.
Thanks everybody for having me. I hope this was a helpful discussion, and I just would iterate that having a good partner to help you procure a quality of earnings report is important as you try to consider a transaction, and they're a pivotal component to most deals these days. So it's an important consideration, and hopefully this was enlightening and helpful for everybody.
Great job putting together the program. I've known Mark forever, just met Steele and Tatjana, but you guys are both very sharp, and we appreciate you all for being with us today.
If anybody has any questions, you can email us at sas@strothman.com. And that will get us any questions that you have. You can follow up with us on the website. We just want to thank you all for participating. And again, to all the panelists, I'm deeply appreciative of you working with me and doing this for us. It was great, and it actually was a lot of fun. I thought it was a really good conversation as well. So until next time, we thank you very much. You can just reach us at strothman.com and see us there.